All right, good morning, everybody. Marie says it's time to go, and I always do what Marie tells me to do, so I guess I better get started here. So, good morning. I know you were worried about it. You'll be happy to know that I actually didn't break the microphone on Tuesday. I just accidentally turned it off. Well, because I got a button on my shirt here, and I stick it underneath that, so when I pulled it out, instead of pulling it out this way, I pulled it out that way. So I know you all worried about that, so I just wanted to bring you up to date on that. So, okay, listen, a couple of announcements. One of the things I was talking about last time was the Connect homework, and you have a lot of resources on Connect, like Check Your Work and things like that. That option is not on every single homework problem. I think it's on about half of the homework problems. So some of the problems actually don't have that on there, but it is on half, if not most, of the problems. So you do have that on there, and like I said last time, you do have two attempts at the homework. Also, I posted, I guess I posted this yesterday, so it's already up on Connect. I went through and I picked some problems out of the book that will serve as good review material for you. I'm actually going to be building this in future semesters a little more, but the problems, even though they're out of Chapter 4, which we're not covering, I think I have 4 problems on there that are good review problems, getting you up to speed from what you did in the prior courses coming into this course. So that's already posted on there. I made it due, I believe, September 10th, which is, I think, a week from today. So you have plenty of time to do that. But I'd really encourage you to do that to kind of get back in the swing of the flow of how transactions are presented on the financial statements, and also the relationship between the financial statements. Okay, so that's on there. Right before I assigned it, I actually ran it by 2 professors who teach the courses that you've already had. One of them is here. The other one is one of our partner institutions. They both looked at it. They both agreed that it was a good, fair review for you guys, that you should be able to do that. Okay, so I have that posted on there. And keep in mind, I have an announcement about this, but keep in mind that of all your homework assignments throughout the entire semester, I only keep the highest 10 scores of your homework assignments. So the more homework I assign, the more I drop. Okay, so look at it like that. So that's a good review there. Also, drop. Oh, what I was going to say is we've already had a couple of individual requests. Some problems with homework. Well, they couldn't do it for this reason and that reason and all that kind of stuff. With 1,038 students, we really can't accommodate individual requests like that. But that's also one of the reasons why I drop the lowest homework assignments. Okay, to control for that kind of stuff, because sometimes, computers freeze sometimes. Sometimes you're doing it in a thunderstorm and it, goes out, that kind of thing. So that helps to control for all of that. Okay? So be reminded of that. So I think right now, I have a total of 13 assignments for you to do this semester, which means that I would be dropping 3 if that's all there were. But we'll see how many we have by the end of the semester. But what I did not just say is that I would drop the lowest 3. That's not what I just said. What I said was I keep the highest 10. So regardless of whether I assign 13, 15, 18, 20, 30, 50, I'm going to keep the highest 10. Okay? All right, so that I've heard some good. Several of you have been up to see the TAs already, and I've heard some real good feedback from the TAs about you guys. The people that have been up there, they say that they've had some real good questions up there, and everybody seems like they're actually putting forth an honest effort and all that kind of stuff. So I just wanted to kind of pass that along to you, that I've actually had some good feedback. So be reminded they're there for you. They are in BA1 457A, which is in this building up on the 4th floor. Their hours are Monday through Thursday, 10:30 to 4. 10:30 to 4. And like I said last time, that's like our beginning hours. We may adjust that as the semester goes along. We may extend it a little bit, like right before an exam and that kind of stuff. But that's going to be the basic hours there. Okay, just another reminder, I've said this every class, I will probably say this every class, if not all semester, at least for the next few weeks. Just a reminder that the videos for this week will close at 7 a.m. on Thursday of next week, so make sure you find time in the next week to do that. A reminder, one of the reasons that I do that, in fact the main reason I do that, is to give you incentive to stay current in the course. Okay, I'm not doing it because I don't want you to see the information. I'm here to give you the information, okay? I'm trying to give you incentive to stay current in the course, because the worst thing you can do really in any course, but especially in an accounting course, is to fall behind. That's the absolute worst thing. That's the absolute worst thing you can do. Okay, so so just a reminder on that. Also, a reminder: if you want to email us, we need to control incoming information. So if you need to email us, make sure you email us at ACG3173. All of that's on the syllabus, so ACG3173 at ucf.edu. Also, something that did pop up since the last time I talked to you guys is you need to email us through the Knights Mail account. Because I mean, if it's just kind of information about the content of the course, that's not a big problem. But if you start asking about your personal grade information, we're going to be hesitant to protect your privacy. Okay, we're going to be hesitant to answer personal information over email in the first place, and we're not going to do it at all unless it's through a Knights Mail account. Because if we get a Gmail account from, Skydiver113 wanting to know, we have no idea who that is. We have no idea, all right? So the best thing to do is just get in the habit of emailing us through your Knights Mail, which you're supposed to be checking your Knights Mail for UCF information anyhow, okay? So email us there, and we just won't have any issues, okay? And we've had a couple of emails that kind of got into that territory. We'll probably get a lot more after the first exam. Okay, and that's when that'll start happening. So the moral of that story is, if you email us through Knights Mail, that would be the best way to go. If you email us through something, for your Gmail or AOL or whatever, that gets a little trickier. Okay, but regardless, email us at ACG3173. If you email us in Canvas or anywhere else, you're going to get a reply saying, "Hey, please email us at ACG3173." Okay, so just a reminder on that. And I think that's it, other than I had a very interesting, one of your classmates came up to me after class on Tuesday and shared with me that they had, I believe they had just started a marketing internship. Wake up, marketing majors. A marketing internship, and the very first thing that they handed this person was a P&L. What's P&L mean? Profit and loss statement, which is kind of a slang term for an income statement. Okay. But that was the very first thing they handed this person, and expected this person to do. I don't know exactly what they were doing with it, but since they handed it to them, they certainly expected them to know how to read it. Okay. That's why we're here. That's why we're here. Okay. Questions? We have a nice. The crowds are getting thinner and thinner every day. I suspect after the first exam they'll even get thinner. And I'm trying to figure out a way to reward those of you who come, and I haven't figured that out yet. But I will. I'm pretty creative, so I'm working on it. Questions? Yeah.
Over the summer in managerial accounting, he had a thing where there was extra credit, but only if you came to class, because it was physical handouts that worked like a paper survey type of thing.
Yeah. Yeah. He's talking about extra credit. Hold that thought for a couple weeks yet. Yeah. Okay. Yeah, and I'm in all those meetings, so thank you for the input. He's talking about iClicker in his other class, and I'm in those meetings, so we share that kind of information. Thank you for making me aware of that. I'll figure all that out. But questions about the course or the material or what's going on? What's going on? Questions? Okay. Then let's go ahead and pick up where we left off last time, which was on the statement of cash flow. I am going to. I'll be doing some writing this morning, and I'm going to do it on here rather than on there, and I've never done it on here before, so we'll see how well it works. What I have done in prior lecture capture classes is I've done it on this and hooked in through the laptop, so if this doesn't work today, then I'll go with what I know works, but we'll see how it goes. So, all right, so we were looking last time, and this is really, Today we're probably getting into some things that you might not have seen before, but what we've done so far should mostly be a review for you. We're talking about the financial statements. There are 4 statements. Those are balance sheet, income statement, statement of cash flow, statement of changes in stockholders' equity, outstanding. All right. Sometimes if the company does not have a sophisticated equity section, you'll see the statement of changes in equity on the balance sheet. Okay, but we tend to think of 3 statements. There's actually 4 because we forget about the statement of changes in equity. Okay, we talked about various aspects of the financial statements last time, and we were talking about the statement of cash flow. This is one of the main purposes for you in this course. This is something that I want you to become much more, familiar with in this course because it's very useful. So here's a guaranteed on the exam. I mean, that's not a great secret. All right. What does the statement of cash flow do? Okay, we talked about this last time. So we talked about sources and uses of cash, but a little more specifically, I mentioned 2 things last time. Yeah. I'm sorry. I meant gray shirt. Outstanding. One purpose is it shows how the beginning balance of the cash in the company went to the ending balance, and you'll see that in a few minutes here with some financial statements I have. And there was another purpose which is, in my opinion, kind of a little more interesting and maybe a little more useful. Cut me some slack on that. Yeah.
It reconciles the accrual basis net income to the actual cash.
Outstanding. It reconciles. Keep in mind that net income is prepared under the accrual basis of accounting. All right. Therefore, there are non-cash items in net income. Okay. Understanding also that if this company was reporting under the cash basis of accounting, they wouldn't need the statement in the first place. Okay, so this is prepared under the accrual basis. Something that you'll be probably inundated with in finance is, well, cash is king, cash is king, cash is the only thing that matters. And we'll be talking about that quite a bit all semester long. Well, down here at the bottom is the actual cash flow for the year. All right, and probably a little more interesting, or maybe a little more useful, perhaps, this is the cash flow from operations for the year. Okay, so what this is doing is it's reconciling the accrual basis net income to the actual cash flow. Okay, and these are the accruals right here. Okay? These are all the accruals right there that are filled with estimates. Okay? And also prime area for manipulation. I didn't say they were manipulated. I said it's a prime target for manipulation. Okay, so very useful information. We get into this in more detail in chapter 9. Okay, but notice there are 3 sections to the statement of cash flow. Those are operating, investing, and financing. I think I'm liking this better than the board already. Because it seems to be working better. Operating, investing, and financing. Don't ask me why, but even when all the way back when I was on your side of the desk, I always remember this OIF. That just always stuck with me. So those are the major sections of the statement of cash flow. The statement of cash flow, I think this is a fair statement, always starts with net income. Okay, because again, we're reconciling net income to the cash flow. So it's going to start with net income, and then they're going to adjust that for all non-cash items. The next item is usually depreciation. Okay, but depreciation might not be the only non-cash item right here in terms of cost of recovery. You could also have outstanding. Amortization, expense, and depletion. Outstanding. Very, very good. Very good. Okay, so you might see those in there as well. All right, so, and like I say, we'll go through this in pretty good detail in chapter 9, I believe it is. But for now, understand that under the operating section, what the accounts that are listed in here are the changes in generally speaking, current assets and current liabilities. Current assets and current liabilities. So notice we have, in essence, a change in accounts receivable, change in merchandise inventory, change in current liabilities. Okay, and sometimes they'll list it in more detail. Accounts payable, notes payable, so forth and so on. So the operating section captures the operating activities, which is primarily current assets and current liabilities. Under the investing section, we have long-term assets. It is a tad bit challenging to write on here because I can't rest my hand on there and write, because if I do, it won't write. So it's the best I can do. All right. So investing activities contain long-term assets. So notice on this simple statement, they have equipment down here. And then under financing activities would be long-term liabilities and equity. Very good. Long-term liabilities and equity. Long-term liabilities and equity. Okay, so that's generally the items that you'll see under the statement of cash flow, okay, when they prepare it. One additional note to this is that sometimes you'll have current assets and current liabilities that are not part of operations, okay, such as, we talked about this last time, notes receivable, notes payable, okay? So in that case, those items might be moved down to one of these other areas of the statement, and vice versa. If there's something down here that is part of operations, then it might be moved up top. But this is the general idea right here. Okay? Questions so far? Yeah?
So notes payable and notes receivable usually in financing?
Probably, yes. Yeah. I'm sorry, his question was notes payable and notes receivable notes receivable would be under investing, and notes payable would be under financing, because notes receivable asset. Yeah, white shirt.
Under each section, the order in which you list things or does it matter?
Well, you'll usually see them listed in order of assets and then liabilities. So they'll usually be listed basically in balance sheet order. Okay, so it probably does matter, but that's more of the problem of the accountant than of us as decision makers. Okay. All right. Other questions? See, now that we're getting kind of a manageable crowd, we can actually entertain the questions. I like it. Other questions? Okay. All right, so like I say, that's the upshot of the statement of cash flow. We'll get into much greater detail on that, believe me, much greater detail on that later. I have a real-life example here, and I know this is kind of small print. This is the financial statements for Facebook. All right, Facebook as of 2013. All right, so if you're watching on video, you can hit pause right now. Google Facebook Annual Report 2013. And you'll find this in there under item 8. Okay, so log in there, and then you can actually see this. Because I know this is real small, but I just wanted to show you briefly a set of real-world financial statements that pretty much conform to the simple ones that we just saw. Okay, so you've got your current assets all up here. Let me just do it this way. Current assets. So we have cash and cash equivalents. We talked about that last time. All right, marketable securities. What are marketable securities? They could be bonds. I beg your pardon? Yeah. Yeah. So usually, he said something easy to turn into cash. Usually highly liquid securities. Okay, so usually either stocks or bonds. Okay, yeah.
But isn't it the same thing as a cash equivalent?
No, that would be T-bills. Bonds are longer term. So I think it would be fair. His question was, wouldn't that be cash equivalents? Okay. No, cash equivalents are very short term in nature. So that's usually more certificates of deposit and T-bills. All right. Marketable securities would be longer term in nature. Okay. So all right. So accounts receivable, so forth. So we've got prepaid expenses. Yeah.
On the last slide, why was the depreciation expense positive?
Okay, now there's a good question. Why is, on the statement of cash flow, why is depreciation expense positive?
Because it's an asset.
No, it's not an asset. Yeah. Outstanding. Depreciation expense, and really the same could be said for all these others as well, but depreciation expense is a prime example of one of our non-cash items. Okay? So in this $18,000 net income, that income has been reduced by $4,000 for this non-cash item. Therefore, to take that out of there, they add it back in. Because remember, what we're doing is we're going from an accrual net income down to the actual cash flow. Okay? That was a good question. Make sense? Okay. Others? Other questions? Yeah, red shirt. Yeah, in net income, in that calculation, one of the things that's in there is depreciation expense of $4,000. Okay? Depreciation expense is a non-cash item because when there's no cash flow associated with that expense. Remember, the point of depreciation is to spread the cost of an asset over the useful life of an asset. Okay? So when they record that expense of $4,000, their cash didn't go down $4,000. Okay? It's an accrual item. Okay? Therefore, they need to add it back to net income to reflect the actual cash flow.
What can be an example?
An example of what?
The depreciation expenses that we're going to add to the net income.
What's an example of depreciation expense? Depreciating a machine. So if you spend, very, very simple example, which actually isn't technically correct, but just for the purpose of what we're doing now, a company buys a $100,000 machine. They're going to spread it out over 10 years. So they would take depreciation expense basically of $10,000 a year. Okay. But during that $10,000 a year, they're not actually spending $10,000 of money. Right. Therefore, it's a non-cash item. Therefore, it needs to be added back into net income for the purpose of reconciling this to the actual cash flow. Okay? Yeah.
What about accounts receivables? I noticed the same thing. It was subtracted.
Okay.
And added.
Yeah, well, yeah, and the change in accounts receivable, and these are, your questions are valid. I don't want to get too bogged down because this is what we're going to do in chapter 9. But to answer your question, with the changes in accounts receivable, keep in mind that if, okay, an example, you sell $50,000 worth of something on account. Okay, so you know that under the accrual basis of accounting, revenue does what? Goes up by $50,000, but also, and what else goes up? Accounts receivable. Okay, that's part of your review homework, by the way. Okay, so keep in mind, kind of like what we're talking about with depreciation, net income includes an increase, in my example, of $50,000 for that revenue, but they haven't received any cash. So that, in effect, needs to be backed out. And that's decreasing it. Okay, and this is what we're going to do in chapter 9. Okay, but that's what's going on here. Okay. To the point that I said a few minutes ago, understand that in this, because we've talked about this already, in this change right here, part of that change is going to include the accounts receivable that the company expects to not collect, which may or may not be accurate. Okay? All right, one more, and then we need to move on.
If it's a decrease in accounts receivable, do you add it?
Yes. Yeah, and that's what we'll do in chapter 9. But yes, yeah. Okay. All right, other questions? I know I just said one more, but I like questions. Okay. All right, so like I said, this is really, the only reason I threw this up here was just to show you an example of real life financial statements. So a lot of these accounts should make sense to you. Accounts payable. Now, developer partners payable, that's unique to this business. And I didn't go back to the notes to look to see what this is, so don't ask me what this is because I don't know. But more importantly, if you wanted to know what this is, then you would need to go back to the notes to the financial statements, because, and you should, when you get home, you should pull up the annual report for this just to reconcile with what I'm doing in class. But also you'll see in there that with financial statements, they have the financial statements, but then behind them is the notes to the financial statements that's explaining all of this stuff. Okay, or it's supposed to be explaining it under adequate disclosure. We'll talk about that in a minute. Okay. Accrued expenses, so forth and so on. So we've got the assets, liabilities, okay, and then the equity section. And like I told you last time, the equity section is one of our primary focuses in this course. So whenever that pops up, make sure you pay attention. So notice common stock, additional paid-in capital, retained earnings. Okay, those are all, we talked about those accounts last time, didn't we? Okay, so, because I was covering financial statements in the class yesterday as well, so I'm kind of mixed up as to what I did in which class, but we did that last time, right? Okay, all right. So we have those those accounts right there. There's one other in there that we'll talk about in a minute, but just for the record, notice that there's also an account in here called Accumulated Other Comprehensive Income. All right, we'll get back to that in just a couple of minutes, but make a mental note that you're seeing it here in the real life statements. All right. Okay, so that's balance sheet, income statement. Again, make sure you remember your template for the income statement, because one of the things that I will do on this first exam is I'm going to give you a list of accounts, and I'm going to ask you questions like calculate current assets, calculate operating income. Okay, so forth and so on. Asking you to calculate the major points of the statements. So notice our basic template right here. Okay, sales or revenue. I'm not. If this were an accounting class, I would split that hair with you. I'm not really going to in this course. But sales or revenue. We have cost of goods sold. So I'm used to doing it on the board. Cost of goods sold, which gets us down to operating income. Our operating expenses, which gets us down to operating income. Then we have interest expense, which gets us down to basically earnings before taxes. They're using slightly different terminology here, but if you understand the concept, then you're on top of it. And that's what I'm trying to get across to you guys, is the concept. All right? Because, for example, what we saw on our simple example last time was income tax expense. Well, on here, they're calling it provision for income taxes. Okay, same thing. It's the same thing. Right. So provision for income taxes, and then net income, and then like we saw last time, our earnings per share information down here. Make sure you know that template. Yeah.
My question was that question you just mentioned is on the homework, and I want to know, like, can I find out how to, because I can't figure out how to do, like, the assets, operating income.
Okay, come see the TA. She's asking a question about the homework. That's why the TAs have office hours. They are there to help you with the homework, and I'm not directing this at you personally, but they're there to help you with the homework, but it's important. I talked about this last time. They're not there to do the homework for you. Okay, so what you need to do is you need to attempt the homework, and you need to submit it at least once. Okay, and then if you can't figure it out, then go to them. Okay. Also, something I mentioned last time is keep in mind that wrestling with the homework is a key part of the learning process. Okay. So you look at something and it doesn't make sense. Don't just go run to them. Okay. You need to sit down and study it. Okay? You need to sit down and look at it. Okay. And I'm not saying you're not doing that, but you need to sit down and look at it and go through all of that process. Then when you go to them, you'll be able to say, yeah, I know it says this in the book, and I read that, blah, blah, and I understand this, but I can't figure out this little piece here. Okay? That's something they can work with. Okay? When you come to them and say, well, I can't figure out problem number 5. And they say, well, why not? And you say, well, because I don't know how to do it. And they say, well, what have you done? Okay? And then whatever your response is, when it's clear you haven't done anything, okay? You need to go put forth effort first. Okay? So with homework questions, see the TAs. That's exactly what they're there for. Okay? All right, and one of the things that I am going to try and do, I had problems, before we get back to this, one more, I had problems with this on Canvas that I did not anticipate, but in a normal class, in a normal-sized class, I can run statistics to see, like on the exam, which questions were causing you problems. On the homework, which questions were causing you problems. So if we have questions that are of particular problem to everybody, I'll probably go over those in class after the fact to make sure that you've got that. When I tried to do that on Canvas for the exam, it said I couldn't do it because, in essence, there were too many students in the class. So I'm going to have to work that out. I'm not real sure what the solution there is, but that's what I do in normal classes because of the 1,038 students that are in this class. I might be a little handicapped on that, so I'll do the best I can for you, but we'll have to cross that bridge when we get a little closer to the first exam. Okay. So, all right. So there's income statement. And again, that's also Chapter 9. They squeezed both the income statement and the statement of cash flow into Chapter 9, and that's not sufficient. So I'll be giving you some additional material on statement of cash flow when we get there. Okay. All right. So we got a statement of changes in shareholders' equity, and I'm not going to get too bogged down in this. But remember, last time I told you to make sure you understand the flow of retained earnings. Okay. And we saw that in vertical format on the simplified one. Notice that on this one, this is actually in horizontal format, so it's kind of going this way, and then time is going that way. All right. So it looks complicated, but it's not. It's just they've taken our simple one and flipped it on its side, okay, and then presented it for a couple of years. All right. So that's what that's all about. And here's your statement of cash flow, okay? Operating, investing, financing, net income is right there, our accrual basis net income. I was telling you about this last time. Notice, and I know it's hard to read there, but when you get home and pull this up, notice that at the very bottom, okay, what they have is the net increase or decrease in cash, okay, and then beginning cash and ending cash. Ending cash at the end of the period, okay? So, and that, again, reconciles from beginning from last year to ending. And by the way, just make a note, I say this because I'm so used to dealing with it, but you kind of seeing it you still being new to it, it may not be obvious to you. The balance at December 31st, 2014 is the same as January 1st, 2015. Okay, so in other words, the balance, when I refer to the balance at the end of 2014, or I refer to the balance at the beginning of 2015, it's the same amount. It's that same amount. So technically, what I'm referring to, either way I say it, and this is true in accounting conversations, either way I say it, technically what I'm referring to is the balance at midnight of December 31st. Okay, now, a little bit of wiggle room there, but that's technically what we're referring to. Okay, so just for clarification, and the same thing in your homework as well. Okay, in the book and exam, so that's standard accounting terminology. Okay, all right. So again, just some real life statements that I wanted to show you. I think we've covered most of these accounts. And by the way, these accounts that you're seeing, this is what you need to know for the exam. Okay, so I'm not going to get on the exam and ask you about what was developer something payable, whatever that was on Facebook. I'm not going to ask you about that account, but I will ask you about basic accounts that you should know, which is this list that I'm showing you on these next couple of PowerPoint slides, and I'm also going to add a few to them. And as we go through the semester, we will add more and more accounts to that. Okay, which is yet another reason why I don't want you to get behind in here, because the material builds on itself. Okay, it's the worst thing you can do is get behind. Worst thing you can do. Okay, so with that, okay, I think we've talked about a lot of these cash and cash equivalents. We've talked about that. We talked about the difference between accounts receivable and notes receivable. What's that difference? No, not short-term, long. Well, kind of a tricky statement because notes receivable could be long-term, but well, not bank loans because it's money that you've lent out, but the difference is accounts receivable arise in the ordinary course of business. Notes receivable usually don't. Okay, so it's going to be something outside of your ordinary course of business. So if you're a note receivable is you're lending money, and presumably you're not in the business of lending money. Okay, you are in the business of selling things on credit, which would be an account receivable, but you're not in the business of lending money. Okay, and there was, did I see a question? Did I get? Oh, yeah.
Is this in the ebook? This page?
It should be. Yes, it should be in the ebook. Okay. All right. So accounts receivable, merchandise inventory, you all know what that is. Very complicated area. We simplify it in here, and this was your managerial accounting stuff. Equipment, you know what equipment is. We've talked about, excuse me, we talked about depreciation, amortization, depletion. Okay, but on that subject, sometimes they don't put that detail on the balance sheet here, and they did not. So notice that on Facebook's balance sheet, they have property, plant, and equipment net. Okay, whenever you see the word net on financial statements, pay attention, because that is always referring to gross net of something. Okay, so in this case, they have property, plant, and equipment of, I guess it would be 2.8 billion, I guess is what this is. Net, what does that mean? Okay, so we're talking about property, plant, and equipment net. They have, well, I'll do it right here. They have 2.8 billion. $2.8. What's that mean? Yeah. Okay, so that's the sum of all their equipment, net of, excellent, net of accumulated depreciation. Okay, so they didn't have the numbers on the face, so I don't know exactly what they are, but let's just say that their gross property, plant, and equipment was 5. Okay, so that would mean that accumulated depreciation is 2. Forgive my handwriting's bad as it is, and it's hard to do it on here when I can't anchor my arm. So just for the sake of conversation, let's say they have accumulated depreciation of 2.2 billion. Okay, what does that mean? What does that represent? Yeah.
Depreciation over the lifetime of
Outstanding. The accumulated depreciation represents the depreciation expense that has been taken over the life of the assets. Okay, so in the example a few minutes ago, I said $100,000 excuse me, asset taking $10,000 every year. Well, the accumulated depreciation on the balance sheet would therefore increase by $10,000 every year. Okay, so that's the depreciation expense that's been taken over the life of the asset. While I'm on the subject, and again, the 2.8, oh, excuse me, the 2.8 is what was listed on the balance sheet. I'm making up these other numbers because I didn't go back to the notes to see what they actually were. But let's say they had $5 billion listed in property, plant, and equipment. What's that $5 billion represent? Very good. Okay, the $5 billion is probably what they paid for it. Okay, because remember, items are listed on the financial statements, generally speaking, at historical cost. At historical cost. Okay, now there's exceptions to that, a lot of which we're going to talk about throughout this semester. Okay, but generally, they're listed at historical cost. So in my fictitious numbers here, they probably paid $5 million, and I say probably because one of the exceptions, just as an example, we dodged Hurricane Erica coming through, but if Hurricane Erica had come through and damaged some property, then a company might write the property down, okay, which would make it down to fair market value. Okay, so that could happen. All right, but ignoring that, they probably paid $5 billion for it. Accumulated depreciation is, as you know, the process of spreading the cost of an asset over the useful life of an asset. So make sure you understand this $2.8 billion, this is what we call the book value of the asset. Okay? Not necessarily the fair market value of the asset. Ultra important point right here. Okay? So it is not fair to say that this property, plant, and equipment is worth $2.8 billion. That would not be a fair statement. Okay? This is the book value of the asset because, first of all, the items are carried at historical cost, not fair market value, although there are exceptions to that. Okay? But in addition to that, the purpose of depreciation is not to peg the asset to fair market value. Okay? The purpose is to spread the cost over the useful life of the asset. Okay? So as the book value of the asset declines every year, because we're taking depreciation every year, okay, as the book value declines, there will be a correlation, there probably will be a correlation between that and fair market value, but the point isn't to peg it to fair market value. Very important point. So if I get on the exam, I don't think I have any true false on there, but if I gave you a true false and said, hey, that means that this property, plant, and equipment is worth $2.8 billion. The answer is false. False. Common misconception, yeah. What would make the fair market value? Well, the fair market value is determined by supply and demand. Okay, so recall from your economics, fair market value, the price it would change between a willing buyer and a willing seller. And that's the problem with financial statements. And we're going to see this in another context here in just a couple of minutes. But the reason the financial statements are recorded at historical cost is because it's more objective. There's less subjectivity in it, okay? I think I mentioned this the first day of class, but when I was going over the brief history of accounting, prior to the market crash of 1929, financial statements were basically recorded at fair market value, okay, which is more subjective, okay? If I send 10 appraisers out to your house to appraise the value of your house, unless they just cheat and look at Zillow, what are they going to come back with? 10 different answers. Okay? So we really don't know what it is until after it's already sold. So therefore there's subjectivity into it, which makes it less reliable. Okay, we're going to see this in a few minutes. That's why we went to historical cost in the first place. Okay? And that's also a common criticism of financial statements, is that they reflect current historical cost. Now, if they had purchased this property 6 months ago, then that's probably pretty darn close to fair market value. If they purchased it 30 years ago, it probably has no resemblance to fair market value. Okay? And that is one of the challenges in financial statements. And an important point, I know I mentioned this yesterday in the other class, I don't remember if I mentioned it in here or not, is to understand that financial statements are just an estimate of reality. Okay? Recall the purpose of the financial statements, and that is, it's going to be on the exam, I promise. I promise. To most properly reflect the underlying economic reality. Okay, I've said that a couple times now, so go back in other lectures if you haven't. Go back in your notes. You've got that somewhere in there. Okay, to most properly reflect the underlying economic reality, but the best we can do is estimate. The best they can do. Okay, I keep saying we like we're accountants. We're not accountants. We're decision makers. The best they can do is estimate reality because we really don't know exactly what it is. Okay? All right, good question. Okay, so that was accumulated depreciation, short-term debt, accounts payable. We talked about that. We talked about accrued liabilities. Okay, what are accrued liabilities? Okay, these are expenses that have been incurred but not yet paid, outstanding. Expenses that have been incurred but not yet paid, such as wages, utilities, things like that. Okay, on kind of the balance sheet equivalent of that would be prepaid expenses. Prepaid expenses. What are prepaid expenses? Okay, these are expenses that have been paid but not yet incurred, like rent and like insurance. Yeah, I'm hearing a chorus of examples in here. Okay, all right. So very good. Long-term debt, stockholders' equity. I've been talking about that quite a bit. Okay. Others we talked about. We talked about prepaid already. We've talked about the difference between depreciation, amortization, depletion already. One of the things we talked about accrued expenses. One of the things that I said a minute ago is that. It's not on there, but it is on Facebook. is that items on the financials are generally recorded at historical cost, but there are some exceptions to that. One common exception is marketable securities, which you see on Facebook right there. Marketable securities. Marketable securities are usually, even under GAAP, marketable securities are usually carried at fair market value because, unlike your house that I send 10 appraisers out to and get back 10 different answers, if this company owns shares in Microsoft, okay, Microsoft is a very highly traded financial asset. Okay? Therefore, the value of Microsoft is very reliable. All you got to do is look at the closing price at the end of the year. Okay? And that is the value for all material purposes. Okay? So because it's easily measurable and reliable, marketable securities are an exception to our historical cost accounting. They'll be carried on their fair market value. Okay. That whole conversation that we just had, we cannot say that for property, plant, and equipment because, number one, it's not as liquid as Microsoft. Number two, they're probably not perfect substitutes for each other. Okay. One share of Microsoft is the exact same as another share of Microsoft. There's no difference. But property, plant, and equipment, there could be differences, even if we looked in this auditorium at the seats. Okay, most of the seats are the same, but some of them may not. Some of them, they may have tears in it. Some of them may be broken. I hope not, but they may be. Okay, therefore, they may not all be perfect substitutes for each other. Okay, all right, and we'll talk about others as we go through the course. Okay, so income statement. Here's your template. We talked about that. Net sales. Here's that word again. Okay, what is net sales? This is probably going beyond your prior courses a little bit because I assume you probably just talked about sales in your prior courses. I might be wrong, I don't know. Okay, so net sales would be the total sales for the period. Deduct what? No, taxes would be later on down the statement, yeah. No, not minus total expenses. Good guess though. I'm trying to spread it around. Go ahead. Yeah. Yeah. So net sales. Remember, always pay attention to the word net. Okay. So net sales would be the total sales net of things like returns and allowances. Okay. Sales discounts. And what's the other one I'm forgetting? Returns and allowances. I'm forgetting one other, but net of those kinds of things. All right. So net sales, cost of goods sold. Cost of goods sold seems easy enough. Well, you sold some stuff. How much did you pay for it? Okay. Well, that could be a relatively easy answer if you're a retailer where you buy inventory and then just turn around and sell it. But if you're a manufacturer, this could be a career right here, just this one line item. Okay. So, which gets us down to gross profit, selling, general, administrative. We talked about all that. Interest, income taxes. At the very end of this course, we're going to spend a session or two looking at the basics of income taxes. So you'll become, up until that point, what we're going to do is we're just going to estimate income taxes based off of earnings before taxes. But when we get to the end, we'll look at it in a little more detail. Okay, and then net income and so forth. All right, statement of stockholders or changes in stockholders' equity. So here are our basic equity accounts. You should know them inside and out. I will say, I think this came up last time. In fact, I know it did because I remember talking about this, but just for a point of emphasis, be careful with your book. And I like your book, which is why I picked it. But be careful because they use the term paid in capital, I think, a little too often. And it's easy to confuse that with additional paid in capital. Okay? When they say paid in capital, what they're referring to are stockholder contributions to the business. Okay? In other words, people buying stock in that business that's newly issued stock. Okay? Capital that's been paid into the business. That's what they're referring to, as opposed to, when you've been doing it this way for when it's hard to spend, as opposed to the profits that the business has earned. Okay, so this is something that I wish I could change in the book, but I can't. So just be aware. Be careful. Don't confuse paid-in capital with additional paid-in capital. Okay, paid-in capital is more of a general term they're using to refer to both of these accounts, and also preferred stock if they had any. All right. Okay, so with that, that's the paid-in capital. So our three main accounts would be our common stock, additional paid-in capital, and retained earnings. Ooh, that was sweet. Retained earnings. Okay. So let's see. Did I leave a slide for myself? I didn't. All right, I'm going to try something here. Yeah, all right. There we go. Okay, so let's say we're looking at a set of financial statements. All right, we're looking at them, and what we see in there is common stock listed for $10,000. Okay. Let's say they have additional paid-in capital of $20,000 and retained earnings of $100,000. Okay, so we're looking at a set of financial statements, and this is what we see. Okay, really important questions right here. Okay, what does that $10,000 represent? Outstanding. Are you an accounting major? No. All right. Have you? I was going to say, have you had this class before? But it's only been taught once, and I taught it, and I didn't see you in there. So, the $10,000 represents the par value of the stock. Okay. So when a company sets up its corporation in the first place, I told you last time to file articles of incorporation and make all sorts of decisions. One of those decisions is they assign par value to the stock. Okay, I've set up many corporations doing this. I've had conversations with attorneys and everybody I can think of. To my knowledge, the par value of common stock is a very arbitrary number. Okay, it rarely has anything to do with the fair market value of the stock. Whenever we were forming corporations, when I was helping clients do it, we would always make the par value $1 per share, because that way it was very easy to look at the common stock account and see how many shares had been issued. That's the only reason we did it that way. You can make it 5, 10, 100, it really doesn't matter, okay, for common stock. Preferred stock's a little different, but for common stock, it's a pretty arbitrary amount. Okay, so this $10,000 is going to be the par value of the stock, which doesn't have anything to do with fair market value. What does the $20,000 represent? Outstanding. The $20,000 is the value in excess of the par value. Okay. So together, these two accounts right here represent the total that's been paid for the stock. In other words, the paid-in capital. This is what I was trying to explain a minute ago. I'm just trying to help you with your book. So this is the total that's been paid into the company. So, for example, in my example here, let's say they issued 10,000 shares at $3 a share. You're starting your business. Okay? I say, yeah, you did so great in this class, I'm in. I want to invest in your business because I believe in you. Okay, so you say, all right, great, I'll sell you 10,000 shares at $3 a share. I say, okay, I got it. So I write you a check for $30,000. Okay, the way it would be presented on your financial statements is and $1 par. Okay, so the par value would go into the common stock under 10,000. The remaining 20,000 that I gave you for that stock would go into additional paid-in capital. Additional paid-in capital. Okay?
You said the common stock and additional paid-in together are the what?
These two accounts together represent the total amount paid for the stock. Now, my example was simple, but with a company that has more of a larger history, understand that this stock could be issued at different times with different fair market values. So this would represent the average amount paid for the stock. Okay, but what's important for us, I think the takeaway from this for us as decision makers is to understand the total, because you'll sometimes see it listed on balance sheets just on one line item. Okay, the takeaway is that together this represents the total amount that's been paid for the stock. Okay, yeah.
So you said if you sold those additional 10,000 shares, that would go into additional gated.
Depends on how much you sold them for. Yeah, he's asking about the 10,000 shares.
Par value is $3.
Yeah, it's selling 10,000 shares at $3. Par value is $1. Okay. So $1 per share goes in common stock. The other $2 per share goes in APIC account. Yeah. Okay. All right. Other questions. This is really important. This is what people don't understand right here. I mentioned this last time. Assets, liabilities, relatively easy to understand. Okay. The equity section is when things start falling apart. Okay. Other questions? Okay. Really important question here as well. $100,000 in retained earnings. What does that mean? What does that represent?
It represents the total amount of the company's put back into the company to reinvest over the life of the company.
Okay, excellent. The $100,000 represents all of the profits that have been retained in the business, hence the name retained earnings. All the profits that have been retained in the business over the life of the business. Okay? This does not represent last year's profits, unless it's their first year in business. Okay? But understand also, and you know this from the statement that I showed you already, how retained earnings, I told you last time, make sure you understand how retained earnings flows. Beginning net income minus dividends equals ending retained earnings. So that $100,000 will be net of dividends that have been paid to shareholders. Okay? So, in other words, the remaining profits that have been retained in the business after distributions to shareholders. Okay, that's what, because I'm often surprised at how many people think that represents net income from last year, the profits from last year. Okay, and that's not what it is. It's the profits over the life of the business. Okay. All right. So that's this, and dividends. I think I talked about this last time. But what are dividends? How do we define dividends? And I'll give you a hint. It's written up there, although I say it differently. Go ahead, yeah. It's what? Dividends are paid to stockholders, but just because a stockholder receives a distribution from the company doesn't mean it's a dividend. Most of the time it is. Small businesses get themselves in trouble this way. Help us out.
Cash payments, from the profits that are left over to shareholders?
They may or may not be cash payments. He said cash payments to shareholders. Yeah, because you can pay dividends in things other than cash. You can pay dividends in property, in which case that would be called payments in kind. Payments in kind. Okay. So usually it's cash, but it doesn't have to be, especially with small businesses. It doesn't have to be. So what I'm getting at is dividends are a distribution of profits to the shareholders, which is what they're saying. They're using the words earnings. Okay. But a distribution of profits to shareholders, that's important because if you don't have profits, you can't pay a dividend. Again, a lot of small businesses get themselves in trouble that way. They make a distribution to shareholders, but they don't have any profits. Therefore, it's something other than a dividend. And they call it a dividend, and it gets into all sorts of issues. Yeah?
If it's not cash, it's paid in kind?
Yeah. Yeah, they're called payments in, if it's not a cash dividend, if the dividend is paid in property, it's called payments in kind. Okay? They can also pay a stock dividend. All right? And we'll get into all of this back, and I think that's like chapter 8 or something like that. Okay? And we'll get into all that there. Okay? All right, other questions? Other questions? Okay. Those are the three, I guess I'll use the word traditional equity accounts, but there's a need for another account, another equity account. I believe this arose in 1992, I believe. Don't quote me on that. I won't put that part on the exam. But somewhere around there is when this issue kind of came up. we as decision makers, when we're looking at this information, there are two key characteristics that we want this information to have. All right? We want the information to be, oh, and I want to do it in the right order, relevant, okay? But we also want it to be reliable. We want the information to be both relevant and reliable. All right? Relevant, I think it would be fair to say that relevant is getting at the issue of timing. Okay, a few minutes ago, we were talking about a building or property, plant, equipment, or whatever. And what I said was, I forget the numbers, but what I said was that if the building had been purchased 6 months ago, then the 800,000, whatever it was that was on there, was, yeah, it's more representative of fair market value. Okay, but if it had been purchased 30 years ago, then it's not going to have any resemblance to fair market value. So how relevant is that information to us? Okay, so that, yeah.
For it to be relevant information, doesn't have to happen in the future and differ between alternatives?
Well, but we don't know what's going to happen in the future. He was talking about happening in the future and differ between alternatives. Yeah, and what you're referring to is the definition of relevant information in a different context. I mean, you're right about what you're saying, but we don't know what's going to happen in the future yet. Yeah.
What if a company buys a building 30 years ago for $100,000 and now they sell it for $10 million? Then isn't it relevant if they're making 30 times the profit?
Yeah, but if they bought it 30 years ago and then they just sold it, yeah, what they just sold it for is relevant because it just happened. Okay, but what I was saying was before they sell it, if it's a transaction that happened 30 years ago, it may not be very relevant. However, if they did just sell it and they received something for it, now that in his example, he's saying they sold it for $1 million. That $1 million is going to be recorded in the financial statements. And because the company actually received something for it, that will make it reliable. Okay, because it's measurable.
Wouldn't that go under capital gains?
Yeah. It does go under capital gains. Okay. But because they received something for it, it's now measurable and therefore it's reliable. Okay. But before that sale, what they paid for it 30 years ago isn't relevant and it's not reliable because they haven't received anything for it, although we could get an appraisal of that building, but we just had that conversation. Okay. So this is the struggle that Kelly and her colleagues are going to go through when she starts her career in accounting to present us as decision makers information to as best they can that is both relevant and reliable. Okay? So what they've done, and there's really not a perfect solution. So if we look at this as kind of a continuum, what GAAP has done is kind of like right in the middle. Okay, so what they've done is on the balance sheet, okay, they're presenting information that is relevant. And what we're talking about here, we'll talk about this quite a bit in Chapter 8. But what we're talking about here is key information in the financial statements, primarily your marketable securities, foreign currency transactions, things like that. What they've done is on the balance sheet, they are focusing on relevant. Therefore, on the balance sheet, they will, forgive my writing here, they are going to record it when it occurs. Okay, I'll give you an example in just a second. Okay. They're going to record it on the balance sheet when it occurs. Okay. But on the income statement, realized. I got my mind on the thing, not on the right. Realized, but on the income statement, they're not going to record it until it's realized. Okay, until they actually receive something that's measurable. Okay, so for example, I showed you Facebook a few minutes ago. Facebook has marketable securities on their balance sheet. Okay. Well, let's say that these marketable securities over the year increase $10,000 in value. Okay. Okay? I told you a few minutes ago that marketable securities are carried at fair market value. I told you why. We talked about that a few minutes ago. Okay? So let's say their securities increased $10,000 in value. Well, has that occurred? Yes, it has occurred. So on the balance sheet, this is a debit, so I'm doing a journal entry here. So on the balance sheet, the marketable securities will go up, will be presented $10,000 higher. Okay, so they're going to increase marketable securities by $10,000 on the balance sheet, but you all know that the balance sheet has to balance, therefore there has to be a credit. Okay, and this $10,000 credit will not go on the income statement because it has not been realized. You with me? This is really important. Okay? They haven't received anything yet. Okay, they went up in value, so we can look on Finance Yahoo and see that they went up in value, but they haven't sold them yet. They still own them, so they haven't received anything yet. Therefore, it's not on the income statement. So they need another account to hold this, and that other account is referred to as other comprehensive income. Okay, so other comprehensive income. All right. This, and I showed you this on Facebook a few minutes ago. Okay, this other comprehensive income, pay attention. This other comprehensive income account is in the equity section of the financial statements, noticing that the $10,000 increase in my example does not appear in net income. Okay? I imagine that all of you know right by now that companies live and die by their earnings per share. Earnings per share is simply net income divided by shares outstanding. This isn't going to be included in that. Okay? But if this actually happened, do you think, would it make sense to you that the value of the company has changed? Yeah. I mean, I would think so. Okay? But it's not included in income. So if all you're doing to analyze a company is looking at earnings per share, which is basically net income, I mean, if you have your blinders on and that's all you're doing, you're not, in my opinion, you're not seeing the whole picture. And that's a part of the point of this course right here. Because there is income information that's not reflected in net income. Now, whether or not you should include it is part of the decision-making process, okay? And that's your call, okay? And that's what we're doing here this semester is learning how to make those kinds of calls, or at least helping you learn how to make those kinds of calls. So you might say, well, it makes sense to me that these marketable securities went up in $10,000 value. So even though they haven't received anything yet, that is a highly liquid asset, therefore it is very reliable. And therefore I do want to include it in my analysis even though it's not in earnings per share. So you might want to adjust earnings per share. So everybody else is looking at $1.32 earnings per share, let's say, but when you adjust it, your earnings per share might be $1.35. Everybody else will say, well, $1.32 per share stinks, so they're selling the stock, so the stock is down 2% one day, and you're sitting there saying, no, because it doesn't include this information, the market's wrong, and you're buying the stock at a bargain price. Okay? Or it could be the opposite. It might be the opposite. Maybe you don't agree with it. Maybe the market actually is taking this into account, and you're saying, yeah, but it's just a temporary fluctuation. This is because of what's going on in China. Okay? So it's just a temporary fluctuation, and it's going to reverse. That might be your analysis. Okay? And which one is correct, I mean, it depends on the circumstances and all that kind of stuff. But my point for the moment is that this other comprehensive income account, in my opinion, is number one, very important because it reflects value in the company, even though it's not included in net income. And number two, not that I've had a lot of conversations with people about this, but I'd be willing to bet you that a lot of people don't really understand what this is all about. So if you understand it and they don't understand it, then you will hopefully be able to make better decisions than them. And you win. Okay? Questions. Let me make sure, hang on a second, let me make sure I got that. Easily measured, yeah, we talked about all that. One final note on this is keep this in mind when you have conversations about cash is king. Cash is king. Because when they receive cash, of course, that's realized. That's measurable, okay? But they might receive the cash 3 years after the transaction happened. Okay? All right, one last question.
When you're talking about the marketable securities and
Yeah.
the balances out, and since you haven't received anything, is that the same thing as if you do accounts receivable, since you haven't received the cash yet, you don't count it?
Is it the same as... His question was about marketable securities changing in value versus accounts receivable not receiving anything. Off the top of my head, I would say no, it's not the same because the accounts receivable would be shorter term. But I don't know. I'd have to think about that. I'll put a pause on that one. But I'd have to think about that a little bit. So, other questions? So, all right, look, this is a good place to stop. So there you go. By the way, I will be out of town tomorrow and through the weekend. So if something pops up and you need to hear from me, you're not going to hear from me till Monday. So I'm not ignoring you. All right, have a good weekend. Enjoy the football game today. Go Knights, and I will see you next week.